everyone to Magellan's latest quarterly video update. Today I'm speaking with Head of Infrastructure and Lead Portfolio Manager Gerald Stack. Well, what a start to 2021 we've had. We welcome the new year with news of a change in US government, perhaps Brexit finally actually occurring, and COVID continues to have second and third waves causing all sorts of issues around the globe. So with that backdrop, we've got plenty to cover off with you today, Gerald, as we discuss the impacts and opportunities for the listed infrastructure market. So let's kick off. Well, Gerald, it seems that many countries have recently announced infrastructure spending programs. However, history tells us that many governments have had a pretty poor track record of actually making these projects happen. Do you think this time it'll be different, or should investors temper their expectations?
I think it's encouraging that governments want to spend money on infrastructure, and that will certainly lead to some opportunities in the event that they do that, some opportunities for infrastructure investors. Of course, infrastructure projects are capital intensive. There's a lot of money involved. They take a long time, and there's a lot of planning involved. So they happen over many years, and often, over a decade or longer, to develop an asset from start to finish. So that's very much outside a single political cycle. And in other words, it takes a lot of time, and therefore governments can disappoint in terms of their the pronouncements about encouraging infrastructure and their actual the runs on the board, as it were. However, we're certainly seeing that governments everywhere are keen to do this, and we do expect there will be some opportunities. So we're cautiously optimistic about that. So then it comes down to what are the nature of those opportunities. And broadly speaking, infrastructure projects fall into two camps: greenfield assets, or greenfield asset development, and brownfield asset development. Greenfield asset development is where the project is entirely new, a completely new toll road, a completely new airport, Western Sydney Airport, for example, in Sydney, a completely new airport. The development of toll roads, as I said, or indeed a new power line to service a community, perhaps. In those situations, the underlying level of demand is not certain, and therefore there's a level of risk associated with that. So that's a greenfields asset. Those greenfields assets developments or greenfield asset projects are typically quite competitively bid. You'll find unlisted infrastructure funds involved. You'll find pension funds involved. You'll find construction companies involved bidding for those projects, along with existing infrastructure companies in the listed market. So quite competitive. They can be great projects, but the nature of the competitive bid process means that there's some risk associated with that. So that's greenfields. The second type of project is brownfields. Brownfields project development is where there's an existing asset, and what you're doing really is enhancing that asset or expanding the capacity or capability of that asset. So you're taking what's already there and you're expanding or enhancing that capability. For those assets, that there's a lower level of risk associated with, because you have an existing demand profile, how the asset already works, so there's a lot less unknowns in relation to that asset, and clearly the existing asset owner or operator is in a pretty good position in relation to that asset. It's a much less competitive situation you would expect. So ideally, what we want to invest in, or what we'd like to see our companies investing in, is those brownfields asset opportunities rather than the greenfields opportunities. And we think our companies are generally well positioned to do so by virtue of the fact that they're operating, around the world. We've got a global portfolio, so they're operating in different markets, exposed to different governments looking to invest in infrastructure, and they're operating high quality assets already typically in a very admirable way. We think they're well placed for those types of projects. So if I go back to the question, yes, there's certainly a level of sort of underlying encouragement for new infrastructure project development, and we're optimistic about that. We probably don't expect huge amounts of that to affect our portfolio, but to the extent that it does affect our portfolio, we're particularly encouraged by the opportunities for brownfields development rather than greenfields development.
Great, thanks, Gerald. A more obvious but highly important question, I think, is the effects of COVID has had on global travel. Clearly, with further lockdown measures happening across the world, as I mentioned earlier, how do you view transportation stocks today? Are they still attractive? What are the risks?
Okay, so essentially what we're after with infrastructure is assets that provide services that are essential for the efficient functioning of communities. Airports and toll roads provide services to transport people and goods to enable the communities they service to operate in an efficient manner. And we don't believe that the demand for that has gone away. In the short term, clearly, given the government restrictions on physical movement of people and goods, that's had a pretty significant impact upon the business models for both toll roads and airports. But we've seen already over time that as the health outcomes improve, as economies open up again, that the opportunities for these assets, for these businesses are returning. So let's think about the two different types of opportunities. So airports first. Airports, the worst month of 2020 was April. IATA's number, the IATA being the Global Airline Alliance, their numbers for passengers were that passengers were down approximately 94% globally across aviation in the month of April. And we've seen that progressively improve over the course of the year. Now, clearly, we're still in the midst of the pandemic. Quarantining measures are still in place. So we haven't certainly seen a return to normal levels, but we've seen a progressive improvement. We've sort of seen, if you like, green shoots show themselves in terms of improvement. And we've seen the numbers progressively improve each month up until November, where passengers were down 70% versus November 2019. So down 70% is still a pretty ugly sort of numbers, but we're seeing people start to come back to aviation and certainly look to come back where those opportunities are available. If we think about aviation, there's sort of three reasons for flying. Leisure, to go on a holiday, to visit friends and relatives, what's commonly referred to as VFR, and then finally business, to travel for business purposes. The indications are where aviation has opened up is that people are very keen to continue to travel for leisure purposes, for visiting friends and relatives as well, but that business travel remains somewhat subdued. And we expect for that to take some time to recover, both for, if you think about businesses, for their cost containment purposes, but as well, the move to Zoom, to Microsoft Teams and the like, to virtual communication is clearly having an impact upon that. So we expect business to be a lot slower in the rate at which it returns to aviation, but we do expect leisure and visiting friends and relatives to come back quite quickly as and when aviation opens up. The other way to think about this is then the sort of the length of the trip, really. A domestic trip versus a regional trip versus a long haul, typically international trip. And there we would expect domestic and regional to come back pretty quickly. So regional being intra-EU travel, for example, or Australia-New Zealand, but long haul to take a lot longer before it comes back. So really as we look to airports, we see those airports that are exposed to either business travel in significant numbers or long-haul international travel. They're the airports that it'll take some time for their business models to return, but we do expect them to return. The IATA, again, the Global Airline Alliance, their suggestions are that travel numbers, passenger numbers will return to 2019 levels in somewhere around the 2023, 2024 mark. The airports who we speak to have suggested anywhere between sort of 2023 to 2028. So they're probably a little bit more sanguine about the rate of recovery than the airlines. But I don't think anyone's under any expectation that people won't come back. Everyone believes that, and that there are good reasons why people travel, and that will happen again. But it will take a while for that recovery to come through. So green shoots can be seen today, but it's going to take a while for a full recovery, with some uncertainty around the rate of that recovery. So that's airports. Toll roads, well, there's really two types of toll roads: interurban roads, those roads that connect multiple towns and cities, and urban roads. If I think about interurban roads, and we look to Atlantia, Italian motorway company, they own interurban roads in France, in Spain and in Italy. And in those jurisdictions in the month of April, in the worst week in the month of April, traffic numbers were down roughly 80 to 85%. So a significant impact again. But again, over the course of the European summer, the Northern Hemisphere summer, we saw traffic numbers return broadly to 2019 levels, probably a little bit down, maybe 5% down on 2019 numbers. Within the second or even third wave, we've seen those traffic numbers worsen again, but it gives you a sense that as and when the health outcomes improve and the economies open up, people will return to traffic, that they will return to their vehicles. In urban roads, if we look to transurban, what we saw was in April, we saw traffic numbers on the urban roads in Sydney, in Melbourne, in Brisbane, down something like 50 to 55%, slightly different from road to road, from jurisdiction to jurisdiction, but of that order. We then saw traffic recover in Brisbane and Sydney down sort of minus 10% or so by the end of the year. The official traffic data is not out yet for the full year, but roughly let's call it down 5 to 10% in Sydney and Brisbane. In Melbourne, worse outcomes because again, as the second wave presented itself in Melbourne and there was the lockdowns came again, so traffic went down, worsened. But again, as looking at Apple Mobility and Google traffic data, it would suggest to us that traffic numbers in January this year are, roughly in line with where traffic numbers were back in the same month in 2019. So in traffic, in toll roads, we've seen traffic return much more quickly to what we would sort of expect, and that's probably not surprising. Traffic ultimately in a catchment is a function of the total level of population in that catchment, and the total level of economic development, the total number of businesses in that catchment. And while economic growth may slow and population growth may slow as a consequence of the pandemic, we don't expect the total stock of population or the total stock of businesses of economic development to change dramatically. And therefore, we expect traffic to be pretty robust and to return, certainly in the medium term, to numbers more normal than what we've experienced over the last year. So in both the case of airports and toll roads, we expect underlying levels of patronage to return. In airports, we expect a much more longer dated recovery, 2024 to 2027, if we take the airports view of the world. In toll roads, a much shorter dated recovery. We expect over the medium term to recover to more normal levels. And ultimately, it's the return of patronage that goes to the efficacy of the business models and the investment proposition.
Great. Thank you, Gerald. I now want to turn to interest rates and inflation, clearly important both to infrastructure assets. While rates remain at record low levels, there is that lurking fear of inflation spiking in the background. Even the small probability of inflation with the amount of debt that is around the world is worrying or could be worrying. How are you handling these risks in your portfolio, and what's your views on these?
So let's think about inflation in terms of the impact upon the businesses, and then and the risks associated with that. So inflation has slightly different impacts depending upon whether you're part of the utilities world or the infrastructure world. Utilities are regulated at the point of earnings. That is, the regulator sets the price that you charge for your service such that you earn a fair return. And to the extent that inflation affects your cost base and your cost of capital, when you go back to the regulator, you adjust your price that you charge so that your return remains appropriate over time. So in other words, as inflation rises and falls, this should have pretty limited impacts really upon the outcomes, the financial outcomes for regulated utilities. So we see inflation largely as a pass-through there, not a significant impact. Inflation for infrastructure assets, well, infrastructure assets typically are regulated at the point of price, or they have long-term contracts that determine their price, and their price is typically connected to inflation. So as inflation rises and falls, so does the price that is charged for the service. The toll on a toll road, for example, grows with inflation, and therefore inflation is automatically passed through to consumers. So again, inflation, not a significant impact for toll roads, airports and the like. And indeed, provided patronage is growing over time, inflation arguably leads to, certainly our analysis would suggest it leads to an increase in asset value over time. In other words, the value of infrastructure assets rather than regulated utilities, the value of infrastructure assets actually grows with inflation over time, treating inflation as a single variable. Of course, the risk with inflation is really not just inflation, but the way that central banks react to that. So to the extent that inflation becomes entrenched and central banks feel that they need to rapidly increase interest rates, then that has further impacts. And it's really the interest rate impacts that concern us more than the inflation itself. Again, if I think about the impact of interest rates on our businesses, well, first of all, it can lead to an increase in the cost of debt. Now, as it happens, the bulk of infrastructure companies around the world have taken the opportunity of the last 5 years to lock in as much of their debt as possible for very long terms at what we would consider to be very cheap prices. So an increase in interest rates today will have some impact on the debt interest cost, but it's been largely ameliorated by their actions over the last 5 years to lock in debt at low cost for long periods of time. So it doesn't impact their debt cost too much. But an increase in interest rates will impact the way that investors value future cash flow generation out of these companies. So to the extent that interest rates rise rapidly, then the rate at which we discount future cash flows is that's going to impact that, and that can lead to value diminution. Of course, to the extent that inflation and interest rates are mild and moderate, this is largely, as I said, largely supportive of infrastructure assets. It's really significant movements in interest rates that would potentially cause us alarm. Provided interest rates are linked to that underlying inflation, then the pricing structure for these assets protects investors in the long term. In the short term, our base case is not that that inflation will become entrenched. It wouldn't surprise us to see some recorded inflation, given the size and scale of fiscal and monetary stimulus that's being implemented in markets. It wouldn't surprise us to see some inflation recorded over the course of the year, but we don't expect that to become structural, and we don't expect central banks to jack up interest rates significantly in the short to medium term. Certainly that's not our base case. So while inflation and interest rates are absolutely risks that we need to be cognizant of and wary of, we don't consider them to be significant or elevated just at the moment.
Thanks, Gerald. I now want to turn to more macro and political conversation. We've seen a change in US government. Does the Biden government have any effects on the stocks in your portfolio?
So there are probably two broad areas of policy coming from the Biden government that we need to think about. One is the transition to a low carbon economy, what they're going to do to encourage the transition to a low carbon economy, and the second is tax. Now, I would add in both cases, given that the numbers in the Senate are relatively finely balanced, they do have a majority, but it's relatively finely balanced. We don't expect any extreme policy, but we do expect a policy agenda to be different from what's gone on in the past, and we certainly expect encouragement of low carbon and probably a higher tax rate. So what are the impacts of that upon our infrastructure? Well, there are three types of companies, three types of assets, three segments we can invest in the US infrastructure world. And they are regulated utilities, US freight rail, and communications infrastructure. In the case of the transition to a low carbon economy, what we expect here is tax incentives and US government encouragement for either renewable energy development and or capital expenditure projects that are going to enhance the effectiveness and efficiency of the electric and energy networks, particularly the electric networks. And we would expect electric utilities to be particularly well placed in relation to these types of initiatives. The development of additional renewable energy renewable energy projects they'll need to be connected to the grid, and the existing electric utilities are the guys who will need to do that. That will lead to additional capital investment in their projects. Renewable energy today is a lower cost energy source than traditional fossil fuels in most markets. and a reduction in the cost of the energy means a reduction in the cost of the customer bill over time. So we would expect this to happen anyway as a consequence of just the improved economics of renewable energy. But to the extent that government policy encourages that, then that ultimately the reduction in the cost of the consumer bill, the energy component of it, is helpful for electric utilities. So that we expect them to benefit from those initiatives. On tax, an increase in the tax rate, utilities are essentially passing through the impact of tax to customers. So as and when the tax rate went down, that had limited to no impact on the utilities. It has a short-term impact on their cash flows, but it really has limited to impact upon their franchise. The same thing essentially goes for communications companies. Communications infrastructure companies are held in tax pass-through entities, trusts, if you like, and therefore changes in the tax rate have limited impact upon them. Changes in the tax rate will have an impact on rail. Rail companies will have to pay a higher tax rate. That will have something of an impact. Of course, they will also benefit from the expansionary fiscal measures that the Biden government looks to be encouraging. So there are swings and roundabouts, but rail probably will end up with a higher effective tax rate, along with all companies in the US.
Similar to the question there on the US, we've seen, let's turn to Europe and UK in particular, we've seen Brexit looking like occurring and being resolved. Any impacts on your portfolio or your views around UK and Europe stocks?
So there's really, again, if you think about the types of assets, the segments that we can invest in the UK, there's we can invest in water utilities, we can invest in an energy utility, National Grid, and we can invest in a company called Getlink. Getlink's actually listed in France, but part of it's essentially half of its revenue is coming from the UK and half from France. So let's deal with them in turn. The water utilities, the domestic regulated utilities, we'd expect limited impact from Brexit. It's difficult to see too much. There may be some short-term issues around availability of chemicals and so on, but limited impact over the medium term. National Grid, UK electricity and gas transmission company. Again, limited impact on those domestic operations. However, roughly somewhere between 40 and 50% of their earnings are derived from the US. And to the extent that Brexit leads to changes in the foreign exchange rate, in their exchange rate, then there's some translation risk. In other words, the sterling value of those US dollar earnings could rise or fall with movements in the exchange rate. Of course, that's nothing different to normal, but clearly to the extent that Brexit leads to some changes in FX, then that could have an impact. Again, in the scheme of things, we consider that to be relatively minor, but there could be some impacts there. The final one is Getlink. Now, Getlink owns the tunnel that connects the UK with France and the EU. And clearly, so it has some very direct impacts to the extent that Brexit leads to lower levels of patronage, either cars, people, or trucks travelling through that tunnel, then that would have a very direct impact upon their business. And there's clearly some risk around that. Of course, Brexit is not a surprise. They've been planning for this for some time, and Getlink has been planning for this for some time. So, while it would not surprise us to see some teething issues and some short-term issues around this, in the long run, we would expect that there'll be more people, more trucks, more cars going through that tunnel than there are today. So the long-term prospects we think are largely unaffected, but in the short term, sure, there may be some impacts. Now, we don't have a position in Getlink today. We're watching what happens there with interest. It's a great asset. And to the extent that we saw significant share price action, then we may look to do something. But it's the asset that's most directly impacted by Brexit. So the regulated utilities, largely unaffected. Getlink, potentially some impacts. We'll watch that with interest.
Thanks, Gerald. Now, finally, turning to the portfolio's performance, can you talk through the recent relative underperformance over the last quarter and whether the portfolio, you believe, is still on track to deliver on its objectives?
Yeah, so we underperformed during the quarter. Of course, during the quarter, we had the announcement of the vaccine. We also had the US election, both things well received by investment markets. And that led to some of those assets that had been impacted early on in the year doing particularly well in that period. We have a conservative definition of infrastructure and a conservative disposition. We have a low level of exposure to airports in particular, but also to other more discretionary components of infrastructure. And it meant that during the quarter we underperformed, essentially. Do the companies that we're investing in, are they performing poorly? No, they're actually at a fundamental level that the performance of the companies is, if anything, probably surprised us on the upside generally. So we're very happy with the underlying performance of the companies in the portfolio. We continue to believe that the investment portfolio will deliver inflation plus 5 real returns of 5%. That's our expectation for infrastructure over the long term. And while in any given year we may do better or worse than that, last year worse, we're confident that the positioning of the fund will deliver those sorts of returns for investors over the medium to long term. And we have no reason to believe that the underlying investment thesis for these companies is broken. Clearly, there's been some volatility and there's been some economic shocks during the year. But the long-term business models for these companies continue to look attractive to us, albeit that there's certainly some heightened levels of risk when it comes to things like airports. Just at the moment. So we don't resolve from the expectation that infrastructure will deliver investors real returns of 5%, and over the medium to longer term, we've certainly delivered that in the past, and we would hope, and it's our assessment that we would deliver on that in the future.
Thanks, Gerald, and thanks for watching. As always, feel free to share this with your clients or colleagues where you feel it may be of interest. And please let your Magellan Distribution contact know if you have any further questions. Thank you.